On Monday, Treasury Secretary Scott Bessent urged investors to buy U.S. assets. By Tuesday, $15 billion had vanished into gold. By Friday, the U.S. dollar had plummeted 9%, its worst decline since 2008. So why is America pleading for investment while its own investors are fleeing the scene? Apple, for example, is absorbing a staggering $900 million in tariff costs, and the U.S. Treasury is borrowing $500 billion just to stay afloat. And behind closed doors, the supposed trade talks with China don't even exist. What started as a political strategy has now turned into an economic emergency, and it's going global. On May 6, 2025, Scott Bessent addressed the Milken Institute's global conference, delivering what sounded more like a performance than actual policy. The U.S. dollar had dropped by 9.2% since April 2nd, according to Bloomberg, with foreign investors offloading a staggering $36 billion in U.S. Treasuries in just 2 weeks. The dollar was no longer the safe bet it once was. Instead of attracting capital, the U.S. was desperately seeking stabilization. The Financial Times reported that both Japan and Germany had halted new bond purchases, citing currency volatility and tariff uncertainty. Despite Bessent's assertion that the U.S. remains the Schelling point of global finance, it begs the question, is this about optimism or is it about damage control? The Wall Street Journal reported that the dollar's 9% fall since the April tariff hike had wiped out any gains for foreign investors, even as the S&P 500 attempted to recover. U.S. equities were up 1.7% year-to-date, less than the inflation rate. Foreign buyers are facing a mathematical problem. Treasury yields near 4.9% just aren't enough to compensate for the currency loss, especially with the U.S. CPI still above 3.2% and energy prices rising 11.4% since March, according to HSBC's Q2 investor briefing. Institutional investors are shifting their allocations away from the dollar and into Eurozone and Swiss franc assets. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. In the week ending May 3rd, the Nasdaq recorded its highest volatility spike since October 2022. Yet Bessent described the U.S. markets as anti-fragile. This starkly contrasts with Goldman Sachs' latest note, which warned of looming valuation headwinds and forecasted just a 3% upside for U.S. equities through Q4 2025. Meanwhile, the Conference Board's Consumer Confidence Index dropped to 95.2, its lowest since June 2020, and McDonald's reported a 6.4% decline in U.S. same-store sales. Amidst this, Bessent's call for upward growth sounds less like economic insight and more like a myth. When mythology meets quarterly earnings season, the disconnect becomes impossible to ignore. But what if this isn't just optimism? What if it's more about avoiding the uncomfortable reality of what happens when spending slows and borrowing spikes? Let's take a step back. When Warren Buffett's famous line, "Never bet against America," is pulled into a Treasury speech, it's often not a sign of strength. In reality, Buffett himself trimmed his U.S. exposure in the first quarter, cutting his stake in U.S. financials by 12%, according to SEC filings. On May 4th, Janet Yellen issued a warning via the Brookings Institution, saying that these tariffs could push the U.S. 40% closer to a recession if critical supply chain disruptions persist. This isn't just speculation. U.S. clean energy firms, such as Plug Power and Albemarle, have already slashed their production forecasts due to blocked Chinese mineral imports. Meanwhile, Bloomberg data shows that first-quarter capital expenditures across S&P 500 firms dropped by 9.8%, marking the steepest quarterly decline since 2009. Bessent's narrative of growth via deregulation, tax cuts, and liquidity seems financially expansive, yet structurally contradictory. While Treasury borrowing has reached $514 billion in a single quarter, and interest payments are projected to surpass $1 trillion by year-end, consumer confidence continues to decline, now at 95.2. On May 3, 2025, gold prices surged by 1.3%, signaling a loss of confidence in fiat stability. According to Bloomberg, this sudden spike was driven by institutional orders totaling over $15 billion after automated sell-offs in U.S. Treasuries. The World Gold Council reported that central bank purchases hit a quarterly record of 290 metric tons, with China and India leading the charge. Meanwhile, the S&P 500 is trading at a forward PE of 21.4, above the 10-year average, while real returns on 10-year treasuries remain negative after adjusting for CPI. This isn't just about safe haven flows. It's about capital fleeing a system that seems over-leveraged. Besant may claim that the U.S. economy is resilient, but the market is placing its trust not in monetary policy, but in gold, the ultimate store of value. The real warning isn't just about the rise of gold, it's about the capital that's silently abandoning the U.S. system. The tariffs on Chinese goods now average 135%, with a 20% fentanyl surcharge still in effect. On May 2nd, the White House ended the de minimis rule, subjecting all imports under $800 to full taxation. This is just the beginning. The Port of Long Beach reported that import volumes fell 19.2% year-over-year in April, and delivery costs for Chinese goods have ballooned. One container ship alone, the OCL Violet, faced an additional $420 million in tariffs on a $560 million cargo. Apple's CFO, Luca Maestri, confirmed that the company expects a $900 million increase in tariff-related costs this quarter. The ripple effects are being felt across industries. Solar panels, industrial chemicals, and electronics are reporting 30 to 40% margin compressions, according to the U.S. Chamber of Commerce. Despite Besant's optimism about long-term resilience, companies on the ground are being choked by a policy framework that lacks operational clarity. GDP data for the first quarter of 2025 revealed a flatline growth of just 0.3%. Meanwhile, imports collapsed by 5.1%, the steepest drop since early 2020, indicating front-loaded consumer demand and severely disrupted supply chains. Janet Yellen's warning on May 4th pointed out that the U.S. was 40% closer to a technical recession, especially since 38% of U.S. industrial inputs are still sourced from China. EV battery manufacturers like Rivian and General Motors are already experiencing delays in lithium and cobalt supplies. Plug Power has cut its 2025 revenue forecast by 18% due to raw material constraints. Meanwhile, Besant's response, with talk of deregulation, reshoring, and tax cuts, seems contradictory. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.